Welcome to another episode of Real Talk. As you can see, I'm not in my home office. I'm in my spring break office, Deer Valley. 60-degree weather, spring skiing. Gotta love it. Anyway, I want to thank everyone who reached out to me after last week's episode on the Palisades Fire. It really means a lot. I mean, that's an understatement. My heart was touched. I sent all the text messages and emails to my wife, and the outpouring of love and support, just unbelievable. This week, we're going back to regular podcasting. I have Paul Fuhrman, the co-chairman and CEO of Miramar Capital. Paul's a mentor to me back from the Latham days. He was the chair of the real estate department, and I was a mere associate underneath him. He's gone on to bigger and better things, first with Colony Capital, working under Tom Barrack, and then forming his own company, Miramar Capital. I consider Paul a dear friend and client. We have a wide-ranging conversation from the market, the types of assets he's transacting on, the types of investors, and also the Palisades Fire. As a Palisadian, he was impacted too. Anyway, I hope you enjoy my podcast with Paul Fuhrman. Welcome to another edition of Real Talk. I'm here with my good friend, client, and mentor, Paul Fuhrman.
I'll take that.
Co-founder, CEO of Miramar Capital. We're in his office. Paul, how are you doing today?
I'm doing well. Thank you for coming here. Made it a little easier on me. Appreciate it.
The 5-minute drive was pretty easy. I say mentor because I met you, I want to say in 2001 or 2002 at Latham and Watkins.
Yeah.
And
that's when I joined. I joined in 2001.
Okay.
And you were shortly after me.
Yeah.
I lateraled in though.
Sure.
But that was, and we had a good run. You did the right thing and left and started your own business.
Well, wait a minute. Did I do the right thing or did you do the right thing? Now I'm sitting in your beautiful office and doing work for you.
Well, yeah, maybe not. I look at, I will say that when I left Latham, it was December of 2007. The financial crisis was in full, and we all saw it coming and it was happening. And I joined Colony in January of 2008. And then, when you're outside of a private equity firm looking in at that time, they look like, kings of the universe. And then you get in and you realize they're like everybody else dealing with a lot of problems from the GFC, vintage investments. So there was a time there I was like, oh crap, maybe Latham was a pretty good safe spot to be, but I have no regrets. It was great. And then we started Miramar almost 8 years ago now.
Yeah. So there's a lot of things I want to cover in a short amount of time. We'll definitely want to talk about Miramar, talk about the market today, and a lot of folks who, whether they're lawyers or brokers or accountants or some aspect of the real estate business and how to pivot from the service industry, being on the service side to being a principal.
Yeah.
So let's first talk about Miramar. Tell my audience, what is Miramar and what do you guys do?
So we're really an operator developer, and we're just shy of $3 billion of AUM now. We're not a fund manager, at least not yet. And we've got about 18 employees now. 6 of us are former Colony Capital folks, but it wasn't really a classic spin out. It was really just me and Jay leaving. And then we've grown since then. We mostly do industrial and multifamily. And I would say that's increasingly becoming like 2/3 industrial, 1/3 multifamily. But what's fun about having your own shop is you can also do other things. We bought back a couple office buildings in the last 6 months at a deep discount. We dabbled in some life science deals. We've dabbled in hospitality and restaurants and, things that are kind of fun and make it interesting. But to your earlier point, I've kind of gone from the lawyer seat to the fund, capital allocator seat to now an operator developer seat. And each step along the way, you kind of realize how little you really know, And I think I'm sure you might feel the same way. Back in the day when I was a lawyer, without having the perspective I have now, having been in these new seats of like an operator developer and a fund manager, God, I probably would be I don't know the law anymore, but I'd probably be a lot better lawyer just having that perspective.
Well, you were a good lawyer back then, so.
Maybe.
Well, you know what? I feel like you're either an entrepreneur or you're not. I don't think anybody can
learn to be one. I just think
Yeah.
you can learn to be a better one.
Yeah.
I think you have it in your blood, right? And when we were at Latham, you were an entrepreneur in the early 2000s with that hotel in Beverly Hills and apartments that I think you own throughout the city. So
yeah,
I want to dive more into Miramar, but what is it about?
Well, I'll tell you this. I think you're right that it's almost genetic. You either have a risk appetite or you don't. But I also think it's important for people to remember that, especially when you're a lawyer, you can always go back. You can always go back to be a lawyer. I was at Skadden Arps my initial part of my career. And then like everybody else in 1999, thought I was going to be a .com, millionaire. We started a .com company for a year. It was going great. And then it wasn't. April 2001 hit. So I joined Latham because I needed a paycheck, And I think a lot of times fear and risk prevent people from making change. And I've always had a philosophy that if I'm going to fork in a road and going left is status quo and going right is change, if it's sort of a toss-up, I always go for change.
All right, so maybe we'll do this podcast in reverse order. So let's double click on that. I meet with a lot of folks today who they're in their position. They've seen their promotes get eviscerated over the last couple of years.
Yeah.
Maybe they're at a large cap private equity company. Mm-hmm. Maybe they're at a brokerage shop and they're just not doing as many transactions as they used to.
Yeah.
And they're thinking about going on the operator side, but it's the golden handcuffs.
Yeah.
We felt it at Latham. Latham paid us well as lawyers. Those that work in private equity, whether it's Colony or others like that, you get paid well. And so how do you just bite the bullet and say, you know what, I'm going to roll up my sleeves. I know I'm not going to make money for a couple of years, but I'm going to bet on myself and hope those promotes come in.
Yeah, I think golden handcuffs are something you just got to get over. Like when I left from Latham to go to Colony, on paper I took an 80% pay cut because I was making good money as a partner at Latham, and Colony said, well, you're unproven. I came in fairly senior, but not at a partner level. And they said, here's your salary and everything else is just, F you, we'll figure it out. And so I was like, okay.
You had a family?
Yeah, I had a family and two young kids. I just had the twins were born. And I had a mortgage payment, pretty big one. And there was a year there where I was like, oh shit. But it just felt like I could always go back to being a lawyer. Maybe you lose a little bit of your clients and a little bit of your, status in the law firm or whatever, but it just felt like I was kind of looking more longer term and not focused on just the near term dollars. And look, then I went to Colony, and you made a good point. Like these cycles wipe out promotes because funds have commingled assets, and a couple bad deals can ruin a whole fund. And I will say, as an operator developer, like it was hard to make this leap. There's never a good time. You can do it when you're young, when your monthly nut isn't that big and your expenses aren't that high. I did it a little bit later in life, but I had some passive income. And then Colony gave us a couple of small asset management deals, but it was me and Jay in a 1,000 square foot office getting going. And as an operator developer, none of our deals, except for a couple of programs we have, are crossed. So we haven't had any home runs. We've had some promotes. It's kind of nice. I've already made more promote at Miramar than I ever made at Colony, which is nice.
So how do you like being on the operator side versus on the capital side?
I like it. And I'll tell you why. I think by and large, if you're in real estate, you want to be as close to the asset as possible. And that makes you more indispensable and more important. And I remember at Colony watching during the GFC when we had a variety of distress situations like everybody else. When shit hit the fan, it was the operator, the quarterback of the asset that people needed. So when the lenders came in and said, well, the equity's wiped, values are down, we don't really need the LP. We don't need Colony. We need the sponsor, the operator, to help manage the asset. So I saw that fact pattern happen a lot. And even our own deals, we've had a couple of office buildings that we bought in Silicon Valley pre-COVID that, were ended up being worth less than the debt. And we were able to buy them back and reset our bases. And that's something that's sort of unique to being a sponsor operator, that you're in the seat where you're in the game all the time, as opposed to being a lender or a capital provider or even a service provider where you're not, in the game as much, I feel like. So I like that seat.
Was it a harder transition and harder to move going from partner at Latham to Colony, or from Colony to starting your own shop at Miramar?
Mm-hmm. I think that's a good question. Because even though I was a partner at Latham, I was still a young partner. And as you know, there was still a ramp. But I kind of accomplished what I was chair of the real estate group. So there was nowhere else at Latham.
Globally, you were chair. Wow.
So I had nowhere else to go sort of professionally other than making more money.
Yeah. So
then going to Colony seemed like a good challenge. And at the time, there were really two private equity firms and LA-based private equity firms that you want to go to, is Oaktree or Colony, I think. I mean, there were others, but at that time, 2007, they were kind of the two giants in LA. So that felt exciting to me, to have that chance of like making that leap. And Tom Barrick was a former lawyer, so he sort of, I think, felt a little empathy to lawyers who wanted to make the transition. So, but that was tough because I didn't have the modeling skills or the Excel skills. I kind of vaguely knew how to underwrite multifamily because I owned it, but I didn't know how you underwrite stuff in an institutional way. And so I had to kind of learn on the job. But fortunately, I was senior enough to come into that world where I didn't have to spend all night, grinding on a model using Excel.
Do you use Excel today?
Very little. But I am good at math. So when someone tells me the model spit out XIRR, I'll say, okay, let's go through the assumptions, because that's wrong. There's something wrong in the model. So I've never had a problem with reviewing them or reading them or anything like that, but don't make me build one, because I'll be slow. I'd be really slow.
So let's talk about the Colony days, and then we'll get into Miramar. You probably won't remember this, but I remember you telling me that a good way to describe Tom Barrick is he was here was an example you said. I think he surfed, and you were interested in surfing, and he gave you the phone number of his surf instructor, and he basically said, I'm going to give you like the best surf instructor, but you better get your ass like in the water. You're going to have to just focus and do this and commit to it, right? And this was just about surfing. I don't know if you remember that, but for some reason that story stuck out, where you were just describing him and surfing, and so I could only imagine what it was like from a business standpoint, of just the dedication, the hard work, and what it was like.
It was at that time before Colony went public, and it was really Tom's really running the ship. It was fun and it was challenging. I mean, that story speaks to Tom's sort of heart, which he had a huge heart, and he's a great guy. He was like my first year at Colony, and I told him I was interested in learning how to surf. And, at the time I was 38 years old or something. And he called me back and said, "Are you serious about learning to surf?" I'm like, "Yeah, I think I'd like to try it." In my head, I was like, I'm going to go down to Santa Monica, hire somebody at the beach and learn how to surf. And he called me back, and he hired this surf instructor and a van and a bunch of surfboards. And he told me to take the next 2 weeks off and surf every day, but immerse yourself in the sport. Like, this is the only way you're going to learn at this age. So for 2 weeks, we just drove up and down the California coast and went surfing. And it was just kind of speaks to how Tom is. Like, Tom is really good at, like, if he tells you about a book, in a meeting, the next day on your desk will be that book with a handwritten note from him, that kind of stuff.
Right.
And he's really good at he's a really high EQ, so he really knows how to read people. I think served him well in his career. So that, like, I think the other thing I'd just point about the surfing thing was, I remember maybe it was our second investor conference that I was part of, he hired Laird Hamilton to be one of our speakers, who was a friend of his as well. Laird Hamilton's a big wave surfer,
Sure.
And he was still I think he was still surfing back then, or at least maybe the tail end of his big wave surf career. And the analogy that Tom made, which I thought kind of stuck with me, was riding a big wave isn't like, it's a team sport. Even though you see one guy riding the wave and it looks incredibly difficult, he actually has a team. He's got people that take him, into the wave, people to rescue him. I mean, it's a whole team sport. Mm-hmm. So the analogy that we tried to make at that investor conference was, hey, this is challenging. There's risk. There's real risk, but you need a really good team to manage that risk. It's not just one cowboy. So I think I learned a lot during those days. I learned some things that we shouldn't do for sure, and we try to use that here at Miramar. I mean, we view ourselves as a small little offspring from Colony, frankly, But I try to take all the good from that experience, and then also some of the mistakes,
So you said that you felt like you accomplished as much as you're going to accomplish chair of the real estate department at Latham, and had an opportunity to go to.
Well, just to put a pin in that.
Yeah.
You can always grow your book, right? You can always make more money.
Sure.
You can become a member of executive committee, those types of things. And certainly my former partners at Latham are all doing really well right now. So, but from just a beyond the money aspect, I didn't really see what else,
I get it. I think I remember being in one meeting at Latham. I can't remember the partner's name. I think it was a litigation partner. I think they were promoting Jamie Wine to partner, and I guess they gave her a pie, because it's like a pie eating contest. When you win the pie eating contest, you get more pie.
Exactly.
And so
my analogy was hot dogs. If you win the hot dog eating contest, you get a bunch of hot dogs. It's like,
you better like hot dogs. So what led to opening up Miramar?
So I think what led to it was two things. It was still that entrepreneurial thing that I have always had, and I had a little bit of a desire. I was enjoying I was buying apartments in Long Beach where I grew up, just south here. And I was buying a 10-unit deal here, a 20-unit deal, maybe a 5-unit deal in Belmont Shore. And I'm having fun with it, and I was probably buying 1 or 2 deals a year. So
self-capitalizing
self-capitalizing the first couple, and then I had some friends and family join me. Mm-hmm. And we had a good run because we were doing it from 2009 to 2015. So it was kind of an upward buying cheap, and rents were going up, and debt was going down. It was, you think you're smart. And I found myself enjoying it almost more than I was enjoying some big complicated deal that I was doing at Colony.
Yeah.
Just collecting rents.
Working on a 10-unit building.
On a 10-unit building, doing a renovation. It was simple, but it was satisfying. So that, plus the fact that Colony had gone public, the dynamic had changed. During that process, Colony was considering this merger with North Star. And so when that came to light, that's when we just started talking to Tom about leaving. And frankly, I told Tom, which I think he appreciated, that I just want to try to see if I can do what he did at some smaller scale. When you try to do something like that, it makes you really appreciate what guys like him accomplished, from nothing. And then next thing you know, you got billions of dollars of assets and huge payroll and responsibilities. So I think it was a combination of those things, but I find it's just more enjoyable when I'm actually involved in, let's say we buy a building and we fix it up, and you can see the outcome and you actually hit your business plan. That's very satisfying. The most satisfying thing, though, is making investors money. And we've had a few times when we've had round trips and investors have made a really nice return. It's really cool. It's a cool feeling.
So when you started Miramar, how did you capitalize those deals?
The first deal we closed actually right before we left Colony. It was like this little $20 million deal we bought in Fremont, California. Mm-hmm. And I was selling a deal. And I had
industrial or multi?
It was a flex kind of office, R&D kind of building. 100,000 square foot building. And we we had like a little bit of an inside track to it through Jay's broker buddy. So we thought, okay, this would be a good exchange deal. I was selling a deal in Long Beach, and I had a bunch of money come out of it and needed an exchange. So we used our exchange money plus a little additional private capital and bought this first deal.
Mm-hmm.
Cool. We have some asset management fees and a promote, but nothing earth-shattering. Well, we got lucky in that deal because the tenant ultimately blew out. We thought that was a bad thing. Then the startup came in. I'm going to really make this long story short. The startup came in. I got great, no credit. The startup's going to be like, they're going to go out of business in 2 years. And then Google bought the startup. And now Google's invested, I think, over $40 million into a building we paid $20 million for. So, that one, our first deal ended up being a home run. Small home run.
Did you sell it?
Home run. No, we still own it. We recapped it and pulled some money out, and it's all good.
Yeah.
So that was our first deal. But when I look at our P&L in the first 6 months of Miramar, it was pretty thin. Just paying our office rent, and we had one employee. We hired the first employee like a month in, and then the second employee maybe 3 or 4 months later.
And so, what was the business model in terms of capitalization? You were in the joint venture allocation world, but you're also personally, starting to syndicate. So, is it? Do you prefer the syndication model? You prefer the joint venture model? Then there's the fund model.
Syndication model is really hard. I thought it was pretty easy in the beginning because everything had gone well.
Mm-hmm.
And these are friends and family, and that pie started growing and growing. We've probably raised $350 million of private capital since inception.
Wow.
Which is a lot. But everything was going great until the COVID interest rates, and then we've had a few deals not do well. And that's the hard part about private capital is I know all these people, and I feel terrible if a thing doesn't work out the way it's supposed to. Even though, COVID was,
who could control that?
Black swan, and cap rates on office buildings now are double digit. Who would ever seen that? And then interest rates going up as quickly and as much as they did. I think we all were looking at the forward curve in 2021 going, okay, yeah, rates are going to go up. But none of us thought it would go up at this pace. So that's the tough thing in private capital. I think when I lose sleep at night, I don't lose sleep at night if the $50 billion institution that invested with me, eyes wide open, if they're hurting and we're hurting, like they're big boys, we're big boys. Okay. But if I have my friend's kids' trust who invested $500,000 into a deal with me and it's going to be impaired, that's a shitty feeling. And that's what kept me up at night and still does a little bit. So that's the problem with private capital. Otherwise it's great, right? They don't ask a lot of questions, and and
you can make all the decisions.
You make all the decisions, and you get pretty good economics.
Mm-hmm.
We do everything market, and we take a lot of care in our investor portal, which I think people would appreciate. I think that's really important. If you're going to do this business, you got to start with an investor-minded mindset. Because I think the real estate deals, we all know that's the business, but you have to be. Those are your customers,
right? So
you have to be really investor-minded.
Well, you're in the service business.
In the service business. And I think because we came from Colony, we kind of understood that fiduciary mindset versus if you're just a developer or a contractor who's making the shift, you don't really get that.
Right.
So our first deal was private capital, but our second deal was not. Our second deal, I think it was our second deal. We were ready to close on a covered land deal in Silicon Valley. Had to put up $1 million of hard money, and our capital partner left 2 days before the go hard date. So, we loved the deal. So we said, fuck it, and went hard on $1 million, which...
On your own money?
Our own money, yeah, which was really hard. And then we scrambled like crazy, and we found some institutional capital and some private capital and got it done, and it all worked out. But you have to have the stomach to do that. And then the third deal we did with an institutional partner, full on, and it was a normal joint venture, and that one worked out too. So our first few deals worked out, and they were all good. We had a couple, like I said, a couple office deals and a few multi deals that in this most recent cycle have been tough. But yeah, I think what was interesting to me was getting to your question before about making transitions. When I left Colony from a fund basically to being an operator developer. I said, well, this should be interesting. How, the day before I leave, I'm on the phone as a capital allocator. And the next day I'm supposed to be calling capital and saying, hey, I'm now an operator developer, like without really a track record. So I was a little worried about that. And what I found is if you just are really diligent, you focus on certain markets and certain asset classes and just, really, really dot every I, cross every T, they will take you seriously. And what we did is we said, okay, we're a small little shop. We're going to focus on California at first. That's it. And we're going to focus on multifamily and office. That was how we started. And we found a deal in our own backyard. It was in Redondo. It was an office deal. And there was a private equity firm in New York that said, okay, you guys are local, you're new, but you're not going to screw this up because this is like, if you do, that your company's over. So I think there's people who get that. They say, like, if Andrew Kirsh starts a new business tomorrow, you're going to be so hyper-focused in the first year to make sure everything works.
You don't have a second chance to make a first impression.
Yeah. So I think there's truth to that. And I think...
but it's hard to get that partner to buy in and give you that chance.
Yeah. It is hard. You have to hustle. And you don't know, like, in this case, it was our first true joint venture with an institutional partner. It was a phone call that I got through someone else that Jay knew, and we ended up having lunch with a guy at R&D Kitchen here in Montana.
Sure.
And I remember walking into lunch thinking, I don't know where this lunch is going, right? Because we all do tons of lunches, and drinks, and dinners, but you never know. And then I had Colony sort of like, and I love this deal, so I kind of Colony like willing to do some quasi stretch senior deal to help me figure out the cap stack, but it wasn't ideal. And then these guys stepped up, and it was great. And then we ended up doing like 5 deals with them. So
maybe it's this deal, but my question is, was there a deal or a moment in time where you and your partner Jay said to each other, this is going to work? I'm glad we left. I feel confident. We're good here.
We didn't really have that conversation, but I would say we started in 2017. It was 2019 and 20 where we started seeing some real money come in. Mm-hmm. Made some fees. We had a couple of exits, so that felt good. Yeah, I don't know that we had that exact conversation, but when we started hiring people, and then we got this office space and signed on to a 5-year deal with some professional looking space.
That looks good. I was impressed.
Yeah, we're like, and we're, the cubes we have, we're almost full on the cubes. So we might get, I don't want to, have a big bloated. One of the things I remember I don't know if you remember, we took over the management of a company called Loris here in Los Angeles.
Yep.
And I remember Loris had maybe 300 million of equity capital under management, which is less than we have today. And I walked into their office, and it was, they'd spent a lot of money, and I just don't ever want to be that way. I want to manage the P&L appropriately, and I don't need flashy offices. I just want it to be nice because
we had our flashy offices.
Yeah, true.
So let's talk about today's market.
Yeah.
Pre-fire, fourth quarter, 2024, presidential election happens. I noticed a complete shift in people's sentiment, tone, deal flow, velocity. We had a lot of deal originations in the fourth quarter. We were busy first quarter of this year, but they were all closings that occurred with fourth quarter originations. Locally, we have the fire, and we'll get into that. But I feel like there has been a shift, not what it was pre-election, but where did that exuberance go? The 10-year has been bouncing around 4.2 to like 4.5, and now it's about 4.3. We have the tariffs in, out, but the velocity of deals, the sentiment has changed quickly, I feel, at least where I'm sitting.
Yeah.
How are you perceiving today's market?
So from a couple of things. I mean, our capital partners that we do deals with, they seem to be ready to jump in, and we're gonna for sure have an active 25. I can already tell and feel it. And unfortunately, some of our capital sources are kind of not impacted by this current issue. And I think the current issue is there's exuberance around sort of, hey, maybe we're going to enter into a deregulation period. Maybe corporate America will be unhandcuffed and, and turn to work. And there's this whole vibe shift about, like guys like Jamie Dimon, leaking that audio about get your ass back to work.
Yeah.
That shift has for sure happened. But now the reality is, I think we're going to have austerity measures here, right? And I think we all want to save money and have the government save money. But that's involving, firing people, less spending. So presumably in the short term, that means unemployment goes up. That means GDP goes down, at least in the short term, if he's successful with these austerity measures. So I think our view is if the current administration is successful in doing all of that, then the bond market should react accordingly and rates should come down.
Correct.
And if rates come down, that's going to be good for all of us, especially for our current portfolio. If he's not successful in doing that, I don't know how our government doesn't get out of this mess without printing more money. I'm not smart enough to know how to do that, but we have $10 trillion of debt that's having to be refied in the next 9 months. At current rates, the government's just screwed, So I think these austerity measures are going to be painful for the next 12 to 18 months. But I am of the view that means cap rates are going to, for the time being, stay a little high. There's concerns about the economy. Are folks going to be spending less money on capital improvement projects, on leasing, expanding, things like that, probably. But that also should create a little bit of a buy opportunity right now, I think. So, for example, we have an iOS strategy that we're doing with UBS. We're kind of leaning toward, and fortunately with that strategy, we can buy up and down the spectrum, core plus, value add, development. But we're leaning towards more core, kind of high quality stuff right now, primarily because it's priced well in this environment with where rates are. And why take the risk? Are you getting paid for that risk? We're also buying some BTR deals right now because we're buying them at, we think, kind of at or below replacement cost.
So they're existing
brand new
Mm-hmm.
BTR deals, stabilized, mapped for individual sales as well. So it gives you optionality on exit. And I'm buying them basically at the basis, if not less than you'd pay if you developed it without the development risk.
Are there certain markets that you're focusing on?
Yeah. On the BTR side, it's purely Nashville, MSA, and the Carolinas. That's it. One thing we like about Nashville is just if you look at the pipeline of new supply of BTR, it's basically falling off a cliff.
Yep.
So, we like what we've got in that market right now, and we're under contract to buy more, and we're going to do more. But outside of sort of that BTR strategy and sort of Tennessee and the Carolinas, we're just doing industrial, light industrial, triple net, iOS, value add, and we'll do the iOS stuff with UBS. We do a lot of our triple net stuff with PGIM, and then outside of that, we find good partners who want to, do stuff with us. And back to your point about starting a business like this, I think the key is that finding that first capital partner. You find that first capital partner that's willing to, make a bet. If it goes well, they become a partner, and then they'll do other deals with you. So maybe I take it for granted, but I guess I should look back on that first joint venture with that first institutional partner. That was important for us.
Yeah, because if that goes, not as successful, then now you have that track record, which is not a track record that you can promote off of to other capital providers. And so that's why it's so critical when I'm talking to clients of mine, you just got to have some points on the board. Don't worry about getting to the last dollar. You need to build your resume of having a joint venture Rolodex so you can go out to the market and say, this is who we partnered with. And, now others are going to be attracted.
Yeah, and your reputation matters. And, we still feel this way for sure, but we early on were very focused on doing the right thing, doing what we say we're going to do. We never backed out of an escrow, except for one where we had a real environmental issue.
Okay.
I that's important because the brokerage community is also important. That first deal I mentioned to you with the capital partner, we got awarded that deal. It was us against PIMCO. Well, how are we going to beat PIMCO out on a purchase? But Kevin Shannon was the broker in the deal. And, he did right by his client because we were paying, I think, the highest price, maybe by hopefully a slim margin. But he said, oh, these guys are good guys. He knew us. When we left Colony, I think the next week we called up Kevin and said, can we have lunch with you? And you need to do that with the right brokers and the right markets to kind of, say, look, we need your help and we won't let you down and we'll be a good client and we'll make you look good. So that was part of the process too.
Yeah.
And now I think we're kind of past all that. And on the industrial side, Lou Friedland, who's our chairman, he's got this. He's a bit of a role model to me because Lou's a very, very good guy who is universally liked by lenders, brokers, and capital partners. And I think it says a lot when you have a 35-year career and you can get to that point of your career and nobody says anything bad about you. And he still made money doing it. You don't have to be a dick. Sorry. And, in business to make money,
Win-win.
Yeah. Yeah. Cause you'll get the nod, you'll get the, hey, you'll get the kind of pocket listing or the, a lot of times these brokers are told, just go to your 3 best clients and see if you can find someone to buy the deal. So yeah, I think it's how you conduct yourself really matters too.
For sure.
Yeah.
And look, it's a large industry, but it's a small industry in terms of who are the players and who can control the market, whether it's capital, brokerage, debt, operators, and it's a repeat business. You're gonna see these people on transactions throughout.
It's crazy how it is a small business, like here in LA, we kind of all know each other, or at least know of each other. But then when I take an airplane from LAX to, let's say, Vegas or anywhere, and I fly, you look down, who owns all this real estate? Even Blackstone doesn't own a fraction of it.
Right.
It's an incredibly huge market. So.
Yeah, no, absolutely.
And it's not a zero-sum game. Like what's nice about LA, Mark Latterman, who you know, right, when he started his shop just before we started Miramar, everybody's rooting for each other.
Yeah.
I
do. Look, I think it's different and it's special. It's not unique to LA. It is in the real estate industry. I feel there are no trade secrets. We are trying to help each other. It's not like in a tech world where your IP, you have to keep it close to your vest.
Yeah.
You don't want your competitors knowing.
Yeah.
There's so much sharing in this market because, like what you said, there's so many opportunities to buy real estate, and it's hard. You have to have the capital relationships, the broker relationships, the debt relationships, private capital relationships. It's not just running an Argus model and having it work out.
It's also oddly still inefficient. So I find a deal I like, and then you might say, well, how do you find the capital partner for it? I end up calling the last 5 people I dealt with or thought about, or instead of having some efficient database of 300, LPs that would like this deal. So there's it's still a very relationship-based business, which is crazy, but it just is, which is also maybe why we like it.
It is, for sure. And it speaks to your personality. So in our remaining minutes, as I told you before we went on, usually I've been putting out these podcasts once a week or a couple times a month, and I hadn't done any since the fires. I did my own podcast to talk about my experiences, and your ex-wife, she lived a block away from me on Isla, and you're instrumental in the Palisades community, and so I know that you have been at the forefront of trying to help the community in launching the Palisades Community Fund. And so talk about what you're doing to just help people and help the Palisades.
Yeah, I have a kind of a personal attachment to Palisades. There's the obvious, but then even before that, my parents lived there.
Oh, that's right.
Before I was born.
Yeah.
They bought a house on Embry for like $30,000 or something.
It's great. And I'm on Hartsel.
Right.
So it goes Embry, Fisk, Hartsel.
And then they ended up at a house on Lockman Lane
Sure.
which my dad always regretted selling. I think he sold it for $50,000. He felt good about himself. So anyway, so they always loved the Palisades. And then when my kids were very young, we moved there to the Alphabets. My kids started at Village and they ended up at Paul Revere, and now they're at Pali High. And I think the Palisades is a great community. I mean, it's just great, especially if you have kids. So when the fires happened, who thought in a million years that they could get down and destroy the entire Alphabet community and then get into Huntington's? And I mean, just unfathomable. And then you see like all these little businesses get destroyed, and you know, the recreation center and where my kid used to do his swimming. And I mean, there's so many examples, and it was just shocking. I mean, I just couldn't believe it at first. And there was a little bit of anger, of course, because certainly Alphabets, we had no water and all of those issues. But I thought, well, I'd like to try to raise some money and help the small businesses. That's where my head was at. Let's, you know, my gardener has like no customers now, or the housekeeper, or, you know, Jerry who has the martial arts studio, or Emily who has the fancy feet.
Fancy feet. My daughter had a performance yesterday or this weekend at Lincoln Middle School.
Yeah. And there's a bunch of those examples, right? What about them? You know, their stories are pretty rough. And then there's a widow who lives, you know, down the street from my ex-wife, who bought her house 30 years ago, is totally underinsured. There's no way of rebuilding. And from what I was reading even this morning, most people are underinsured by a pretty material amount, meaning like to be rebuilt. So anyway, I thought we should try to raise some money. So I was going to start a 501c3, and I called I think it was your reference, Kent. Yeah,
Kent C.
Yeah, Kent C. Good guy. And he said to me, he's like, "This is great. I'll help you out." There's another real estate guy trying to do the same thing.
Yeah.
And it was Bill Fischel, you know, and it was, you know, Bill's the chairman of Make-A-Wish now. I'm sure I'm part of the reason why he got roped into Make-A-Wish years ago. He's very philanthropic. He's a great guy. He's a force. And he was really like, let's do this. And so we teamed up, and then we recruited a few others, Sam Beck-Shandapur and you and others to help out. And we put on this event, you know, as you know, at the Rose Bowl, which is just the beginning. I mean, to us, the event's not that important. The event was just, hey, let's raise some money, get this community fund set up. But the importance was Palisades doesn't have a community fund. So if you go to one of these events, let's say Fire Aid concert, where's the money going? Great, it's great to have the concert. They raise a bunch of money. It's going, I think, to like the Red Cross and some other sort of, you know, tangent kind of charities. But people are asking right now, well, wait, how do I get access to any of these funds? So we're trying to do that. And so we had this first event. We're setting up this board now. We'll probably hire an executive director. But the goal is to have a durable, everlasting community fund that can be a place for, hey, if you want to support the Palisades, this fund has only one goal, and that is to invest back into the community. So I think we're going to have all that kind of set up in the next month or two. And then, you know, it's already obviously got funds from the first event. We've got other events that are happening now that people are saying, oh yeah, we'll donate to the Palisades Community Fund. And to try to be kind of helpful, I guess, we also simultaneously set up the Altadena Community Fund. But since we're not from Altadena, we're letting those folks handle that. But my hope and goal is that we'll have this community fund with members of the community on the board. And the community fund can be a place where, hey, when you have, you know, they can support the 4th of July parade, or they can support, you know, something new at the Pali Rec Center, and or maybe the public schools need support, you know. So I think I'm optimistic that 5 years from now, the Palisades will just be phenomenal.
So you said 5 years. So that is the question that every single person, they have an opinion. And you ask 100 people from the Palisades, or you forget, you don't even have to be from the Palisades, 100 people from the West LA area of when. And it's important, like, what is the question though? Because there will be people who may be able to build their house quicker than others. But when do you think the Palisades will be relatively back to normal?
I'm going to say optimistically, I know this is probably wrong, but I'm going to say 5 years. And the reason I say that is just watching like my ex-wife's place. They came in early and got rid of all the toxic stuff. I don't know what your story is.
No, my debris is cleared.
And then the Army Corps came in a few days ago, cleared out everything.
Mhm.
I mean, she's already in advanced conversations with a few builders, and I think she's picked one. The tough thing is the pricing issue because, the quotes are anywhere between $750 and $1,000 a foot
Mhm.
for a house in the Alphabet region. I'm not sure if you get more custom. And if you're building within 10% of your original house, they're supposed to just fast track all the permits. So my guess is a good chunk of homes are going to get rebuilt and started in the next 6 to 9 months because those people have the insurance or the capital to do it. There's going to be a whole lot of lot sales because there's a lot of people that just.
I heard there's already something like 80 to 100 lots on the market.
Yeah, that's higher than I heard, but that's a lot. But if you're buying a lot, presumably either you're a developer or you're someone who has the financial wherewithal to build on it.
Mhm.
You're not just buying it to bank it, I don't think. So, I think if you're a buyer of a lot over the next 9 to 12 months, you're probably planning to hit the ground running as soon as you close escrow. So my guess is that, most of these lots will have something starting in terms of construction in the next 18 months.
Mhm.
That'd be amazing. And then, the Palisades is an 18-month process to build because they allow you to construct on Saturdays. Maybe they'll expand that. Like in Santa Monica, if you're building a house, I think the rules are like 9 to 4 p.m., no Saturdays or Sundays. In the Palisades, it's
You could build. Why not build 24/7?
right now, why not, right? There's
You're not bothering
You're
anybody.
not bothering anybody. It's still true. So, and then they're going to put the power lines underground, apparently, which would be cool. So, I'm optimistic.
I'm optimistic too, but government needs to shift their ways. Here's one example of where they have it. And we all hear stories, right? One homeowner wanted to do some adjustments and needed to notify the adjacent property owners and needed to literally give them a written notice of this is what I'm doing. And he said to the city, they don't have mailboxes. They're all gone. How do you want me to deliver this notice?
Right.
And the city said, you know what? Good point. We'll get back to you on that. So there are things that, and like, trees have fallen down and there's urban forestry wants to make sure certain trees are protected. And I get that, but there needs to be a common sense approach to rebuilding this community.
Yeah.
And sometimes government doesn't display the most common sense.
It feels like the will is there, though.
Oh, for sure.
The pressure is there. So, yeah, I mean, you could do a whole podcast on the ineptitude of our local government officials.
Well, I think that was Joe Rogan and having Rick Caruso on.
Yeah, that's true.
So look, Paul, we could talk for hours about Miramar, about our days at Latham, about the Palisades Community Fund. I just want to thank you for being a mentor in my early days at Latham.
And I'm proud of you. You've done a great job. And as a client of yours, I think you provide a great service sort of in a segment of the market that is not that well served. So good job.
Appreciate it. Good luck to you and Jay. And I know Miramar is going to crush it for years to come.
Hopefully we'll keep you busy this year.
All right. Thanks, Paul. Appreciate it.
Yeah. Thanks.
Thank you.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show